Hello everyone, we are Group Champion Trade, which are students currently studying in UMSKAL Malaysia Sabah. Now we are going to have a video presentation for our case study assignment, which is titled One Country, Two Systems and a Top Regional Business Hub. So before we start the video presentation, let me introduce the members from our group. Okay, from the first one, there's me, and there's Peng Chuan. The next one, there's Rena, and then Farhana. And the last one, we have Katis and Razik. So basically, each of us will be presenting one question from the case study. So let's go.
Hello, I'm Katis here. I'm here to present the answer for question 1. Yes, I do agree with the metaphase that China and Hong Kong are the business symbiosis. What is a business symbiosis? Business symbiosis is defined as a relationship between two or more countries which any of the countries will gain some sort of benefit from the relationship. This business symbiosis of these two countries, which is China and Hong Kong, can be proven by the business relationship that they started operate before the year of 1997. For example, Hong Kong trader had support the China export by re-exporting China goods by using Hong Kong export quota when China exceed export quota for product like textile and clothing. Besides that, Hong Kong trader is the second largest foreign investor of China economy, which is 13% of foreign investment, which is the largest supporting investor of China economic growth and the modernization. In a recent years, there had been many Hong Kong-based companies that shift their manufacture facilities to China, and the tandem of the two economy has rose to become the region's top business hub. So this has proved that China and Hong Kong have a good relationship in a sense of business and the foreign investment. So that's all from me. Thank you.
Hello there, my name is Farhana. Today I will be discussing about the main determinants of foreign direct investment in China compared to Hong Kong. First of all, FDI have two types. The first one is market-oriented FDI, and the second one is export-oriented FDI. So I will talk about China. China have 3 points. The first one is the size and growth of the China economy and prospect. China has 1.2 billion population of citizens with high demand of consumption. The scale of China economy reconstruction have been growing with increasing purchasing power of the people and fast changing pace of the market. Okay, the second point is cost and reproductivity of labor. China has rich resource of labor. Not only that, they are high quality and numerous technician personnel. This makes export-oriented FDI to concentrate in labor-intensive industry, where China have a long-standing success in exporting cheaper labor costs. Okay, the last one is technology infrastructure. China government has started to place more emphasis on technology-intensive investment, for example, computer, electronics, and so on. Foreign company investing in China, especially research and development activities to better adapt their technology to the needs of the local markets. Next, I will talk about Hong Kong. Hong Kong also have 3 points. The first one is advantageous geographical location. Although Hong Kong economy is 6 times smaller than China, but Hong Kong has enjoyed a favorable position in the world of FDI. And China significant presence in Hong Kong by putting their fund in anticipation of getting business opportunity on the mainland. This proves Hong Kong's unique position as a gateway to the vast mainland market and a platform for mainland enterprises to enter into the global market. The second point is sound infrastructure. All telecommunications in Hong Kong are known for foreign ownership restriction. The increase in FDI reflect a major cross-border merger and acquisition in telecommunication in Hong Kong. And China Mobile, that based in Hong Kong, has acquired several mobile networks on the mainland. And the third one is low tax regime. Hong Kong does not offer target incentive regime to overseas investor. However, its duty-free status, low tax rate, good infrastructure, freedom from government interference make it attractive to the potential investor.
Okay, hey guys, my name is Lau. I'm going to present question number 3 from the case study. So, according to UNCTAD, the number of foreign firms in Hong Kong has dropped from 1997 to 1998. This happened is due to the 1997 financial crisis, Asian financial crisis. This crisis are also known as Tom Yam Goong crisis, which started in Thailand when Thai government was forced to float the baht due to the lack of foreign currency to support its own currency pegged to the US dollar. This burden of foreign debt had made the country to declare bankruptcy before the collapse of its own Thai baht currency. This crisis had also affected most of the Southeast Asia countries, which also include Hong Kong. In addition, the handover of Hong Kong's sovereignty to China during the crisis period had also caused the foreign firms to reduce. The ignorance of the investors on the economy's risks and the political uncertainty of the future of Hong Kong as an Asian financial center led some investors to withdraw from Asia, especially Hong Kong. Okay. In 2000, the number of foreign firms in Hong Kong had increased, which we can explain in 4 reasons. First is the recovery of the economic turmoil of 1997 to 1998. After the happenings of financial crisis in 1997, the affected countries had worked together towards the financial stability on financial supervision. The Southeast Asia countries had maintained their high interest rates, which target the foreign investors that were looking for high return, had led the Asia to attract nearly half of the total capital inflow into the developing countries. A marked growth in reinvested earnings can be related to the improved profit position of foreign affiliates in the economy. Okay. Besides that, the transnational corporations, or known as TNCs, which had the intention to invest in the mainland of China, they parked their fund in Hong Kong. TNCs put their funds in terms of long-term loans in Hong Kong, which they anticipate to have a business opportunity in mainland of China. Okay, the increase of foreign firms in Hong Kong reflect a major cross-border merger and acquisition in telecommunications. For example, China Mobile Company, which based in Hong Kong, had acquired a total of 7 mobile networks on the mainland with a deal value of more than 30 billion US dollar in November 2000, with part of the deal financed by 23 billion US dollar in capital raised through new shares issued to its parent company in the British Virgin Islands. Okay, last but not least, there is an increase of transit foreign direct investment or FDI into and out of the Hong Kong. A part of Hong Kong's investment inflows and outflows are related to business ventures elsewhere in the region, especially on the mainland. This issue is also further complicated by the round-tripping phenomenon. For example, the capital inflows and outflows which are related to Hong Kong were through the tax haven economies countries like British Virgin Islands, the Cayman Islands, and Bermuda.
Hi, my name is Rina Natasha and I will talk about rosy macro and lousy micro. The statement what you have in China is rosy macro but lousy micro is true. Rosy macro means when a country's macroeconomic is in a good condition. As China's stock market have grown to be the second largest in Asia after Japan and also the world's best performing. So, in macroeconomic perspective, the investors are highly likely to invest in China. Lousy micro means that the country have bad microeconomic condition. China's strong economic growth could not prove the high corporate profits in the country. Although Chinese authorities had permitted the locals to buy B shares and the B share market had soared high, the return earnings did not match with the high level of investment. The competition in domestic sectors is very intense with the additional involvement of WTO membership has made the companies to compare in pricing power. This has caused the investor to have difficulties in investing specific stocks. In order to improve the return earnings of investors, it is recommended to focus on companies with strong and growing consumer brand presence in China. For example, Hong Kong listed clothing retailer Giordano, Red Chip Telecommunications, Giant China Mobile, and China Unicorn. Next, investors can also focus on China's vehicle stock, whereby most of the companies had joint ventures with the Western companies like Honda and Isuzu. Next, property stocks are attracting attention as government policies aiming at boosting property ownership and the introduction of mortgage lending, which led the residential prices to rise fast. Then, China's airline industry is currently the growing consumer demand for domestic leisure travel. And the energy sector, which include oil and gas, also contribute to China's continue economic growth. And lastly, the infrastructure sector like Zhejiang Expressway and the Olympic Games with promising opportunities can be targeted by risk-averse investors who want direct and dependable exposure to economic growth in China.
Bismillahirrahmanirrahim. Assalamualaikum. My name is Muhammad Razik and I will present the answer for the question number 5. For this question, the question asks for which form of investment is more volatile between foreign direct investment and portfolio investment. In terms of definition, foreign direct investment or FDI is an investment made by a company as individual in one country in business interests in another country in the form of either establishing business operations or acquiring business assets in the other country, such as ownership or controlling interests in a foreign company. While portfolio investment is a hands-off or passive investment of securities in a portfolio, and it is made with the expectation of earning a return. So, compared to FDI, portfolio investment is more volatile. The volatility of the portfolio investment can make the economic problem worsen during uncertain times. China's FDI are involving in long-term commitment in the economy and are relatively stable compared to China's portfolio investment, while Hong Kong is a free territory for investment, which means that foreign companies can be set up freely, register their brands, and the director of the company or their managers does not always have to be the citizen of Hong Kong. Hong Kong government is very encouraging this type of investment with favorable taxation policy and light legislation.
Hi, my name is Chao Meng Chuan. I will present question number 6. So between Hong Kong and China, I prefer to invest in Hong Kong. There are few reasons I prefer invest in Hong Kong. Hong Kong seems a gateway to China for those who are interested in doing business, in access the Chinese stock and investments. And Hong Kong is also a preference destination for listed company, as the Chinese stock market are more conservative. The reason that I prefer invest in Hong Kong is because the Hong Kong economy is characterized by low tax, less government interference, and free trade. Compared to China, Hong Kong has low cost and easy to approve the business. Hong Kong has a free economy markets, and the high independence on the international trade and finance. The value of good and service trade, including the sizable share of re-export, is 4 times GDP of the Hong Kong's. On the other hand, China has corporate tax average 29.4% from year 1994 until 2016. The second reason I prefer invest in Hong Kong is because Hong Kong has a free trade, which is no tariffs on the import stock of goods, and it's only 4 commodities has the tax, which is hard alcohol and tobacco, hydrocarbon oil, and mystery alcohol. The Hong Kong has also no quotas or dumping law tools. On the other hand, the traffic rate in China in 2014 is 3.54%. Hong Kong is also a financial center, which is world ranking number 4. For those who are interested in invest in Hong Kong, they were easy to get the loan to access their business. For China, if compared with China, China have also financial center in Shanghai, which is world ranking number 5. But compared to Hong Kong, China has high commercial lending rate, which is 5.73% until 6%. But in Hong Kong, there are 5% commercial lending rate. So lastly, Hong Kong has a strong, transparent legal framework based on the common English law. If compared to China, have Chinese law, the English law is more common if compared to the Chinese law. The Hong Kong is also provide a business environment and favorable regulatory with a high degree of banking confidential. This is also no tax for foreign sources incomes remitted to Hong Kong. That's all from us. Thank you for watching our video. Thank you.